Good afternoon, everyone. It's Pablo.zuanic, Cannabis Analyst at Zuanic Associates. Thank you for joining us via Zoom, via Twitter, and via other platforms. We'd like to welcome our panel today. We have the CEO of Advanced Flower Capital, Dan Neville, CEO of NewLake Capital Partners, Anthony Coniglio, and Managing Partner, Peter Sack at Chicago Atlantic Group. Welcome to all three of you.
Thank you. Good to be here.
So look, we have a lot to cover. And for those of you listening here, we are trying to focus a lot in our calls on the industry itself, right? The fundamentals of the industry, the different angles, ancillary services. Sure, what's happening in DC matters a lot, but we're trying to remind people, hey, there's a real industry here, 500,000 jobs, $32 billion in sales. That's just counting cannabis, not ancillary, and the multiple other industries that support cannabis. And then, we calculate between income taxes and sales taxes, about $8 billion being generated at the federal level and state level, right? So obviously a very real industry. We'll just start with introductions first. Dan, just remind people of Advanced Flower Capital, of what you do. Thank you.
Sure. So Advanced Flower Capital is a publicly listed mortgage REIT that trades on the NASDAQ under the ticker AFCG. We're a dedicated lender to the cannabis space. Our book in the cannabis space today is about $350 million. And in total, over the life of AFC, we've deployed about $850 million into the space.
Great. Thank you. Anthony, go ahead.
Yeah, Pablo, thanks very much for having us. And apologies in advance for my voice today, getting over a little bit of a cold. But NewLake Capital Partners is a real estate investment trust. We're an equity REIT. We actually acquire properties from and for cannabis operators. And today, as we count it, we're the second largest owner of cannabis real estate in the U.S. We own 32 properties across 12 states with 13 tenants. Some of the leading names in the industry, like a Curaleaf or a Cresco or a TrueLeaf, are our top three tenants. We own cultivation facilities as well as dispensaries. We're also publicly traded under the ticker symbol NLCP, and we're excited for the conversation.
Thank you. Peter, go ahead.
Good to see you all. Thanks for having us, Pablo. Chicago Atlantic is a lending platform focused on serving the U.S. cannabis industry. We operate a publicly traded mortgage REIT under the ticker REFI. We have a publicly traded BDC under the ticker LIEN, L-I-E-N, and operate private funds, all focused on lending into U.S. cannabis operators.
That's great. Thank you. Look, Peter, I'll stay with you. It's the same question for all three of you. There is this negative sentiment from an investor perspective with stocks. I mean, I'm referring to plant-touching companies in terms of valuations, where we are in terms of the cycle. But does that apply necessarily to industry fundamentals? How do you see that? Do you see the industry economics stable, worsening, improving? Is it becoming more difficult for you to find eligible borrowers? Does this impact your cap rates, in terms of your ability to focus more on quality than quantity? And perhaps you have to be more selective about who you lend to, and that may affect your cap rates. But just in general, just talk about your view of the industry and how that impacts the way you're doing business. You first, Peter.
Mm-hmm. From an equity standpoint, I think equity valuations historically and currently are indexed largely towards the expectation for federal or specific state level cannabis reforms, rather than necessarily indexed towards fundamentals. As a lender, we are focused first and foremost on downside protection, cash flow, ability to service debt, and ultimately ability to refinance debt. And so the lens that we apply as a fixed income investor is different from the lens that an equity investor may apply. And so I think all the people on this call throughout the booms and busts of the equity cycles, with a focus on fundamentals, ability to service indebtedness, and pricing appropriate risk reward, are able to work through and deploy capital really effectively, regardless of where the equity is trading. And with a focus on extremely low leverage, particularly relative to the broader private credit industry, and a focus on leverage relative to real cash flow, you can lend at still very attractive loan to values, whether the company is valued at 5 times or valued at 5 times EBITDA or 15 times EBITDA. And so, um, and so on a market basis, I think as most people know, there really isn't fundamentally a U.S. cannabis market. There are 40 distinct recreational and adult use markets, and within those markets, there are distinct supply and demand dynamics and attractiveness dynamics for various parts of the supply chain, whether that's cultivation or retail or other pieces. And so as the industry's matured, I think our challenge and opportunity is to leverage focus on this industry in order to be continually identifying which parts of those markets are really attractive from a debt capital standpoint and which parts of those markets are not attractive from a debt capital standpoint. And as lenders, we can pivot in and out of markets more nimbly in the span of years than I think than the cannabis equity markets can necessarily.
Thank you. Dan, the same question for you. And the context really here is that we hear about economics getting worse in certain markets, pricing or profit margins coming down. We don't have 280 relief yet. Is that true, first of all? Are things getting worse, and does that impact the way you do business?
Yeah, it's market by market, as Peter said. There's 40 distinct markets out there, right? And each of them is at different points in the maturity curve. So you have some markets that are medical markets and very immature medical markets that could be great markets longer term. Put Georgia, some of the other states on the board. You have markets that are very mature and very, very advanced in terms of competitive dynamics and where they are in the cycle. Put Michigan and Massachusetts in that area. And then you have markets that are newly AU, markets that are a little bit long in the AU tooth, where additional retail competition is coming in. Illinois and New Jersey are probably pretty good examples. And so I think you just got to look at and be cognizant of where a market is in that maturity curve, right? You get a boost ahead of AU and a couple years of outsized profits related to the AU flip and the 1.5 to 3x multiplier that you see in those markets and excess returns over that period of time. And then eventually additional licenses and additional competition come into those markets, and the pie grows, but probably not as much as the competition is growing, and you enter a more mature stage of these markets. And so we view it as, as Peter said, we typically have a term of 3 to 5 years on our loan book. And we're able to underwrite on the start and pivot as needed and modify loans as needed and monitor our portfolios to adjust with the ebbs and flows of individual markets. I'd say looking at Q3 results, I think Q3 was disappointing. I think if you're looking at this as a growth industry, right, the growth was non-existent. In fact, it was, a bit negative as people we're seeing increased retail competition in states like New Jersey and Illinois. But from a profitability perspective, it was halfway decent. EBITDA, cash flow generation was okay. But as Peter said, those are the metrics that we look at. We're looking to lend out money with an appropriate margin of safety at the top of the capital stack. We're able to earn equity-like returns while we're doing that at the top of the capital stack, or at least target that, and pivot and weave as these markets change. And I think that's been our approach, today that's been our approach previously when the equity market caps were $40 billion in aggregate. And that's our approach today when the equity market caps are $10 billion in aggregate. I think in terms of the opportunity set, you asked, is it more difficult to find borrowers? There's certainly states that are no-fly zones for us. Michigan and Massachusetts probably rise to the top of the list today. But for every state that becomes a no-fly zone, there's new states that are coming online. Georgia, Kentucky, Alabama. And I think there's also a bit less competition in the lending space generally than there was previously. You've seen some notable exits on the fund side of things, some of the regional banks getting out of this space, some of the sale leaseback providers getting out of this space. And so that allows us to be more selective and focus on moving up the quality curve while still achieving, or targeting appropriate risk-adjusted returns for the industry that we're lending into.
That's great, Connor. Thank you. Anthony, same question for you.
Yeah, I'm going to try to not repeat what my colleagues have said because I agree with all of it. Let's start with sentiment. It stinks. Let's just call it for what it is. It really stinks out there from an investor sentiment perspective around this industry. And it's I might be controversial in saying this. I think it's partly the industry's or largely the industry's fault. I don't mean the people on this call. I mean the industry at large, because every time we've gone through a cycle of potential change, potential legislative change, I think that the industry at large tends to I don't want to say exaggerate what the opportunity could be, but maybe takes an overly optimistic view about the timing and the impact and the likelihood of whether it be legislative or regulatory change. And that creates expectations in the mind, particularly of equity investors. And then we could see the impact on equity prices. You could just follow it all the way back from the Biden beginning of the Biden administration and see how that sentiment has changed. I feel like we're very much in the trough right now for many reasons, but we're very much in the trough from a sentiment perspective. But as my colleagues on the call here have said, from the fundamental perspective of the businesses that we all focus on, we're focusing on operators that can survive through this type of a difficult and uncertain environment. When we all do our underwriting, whether it be them and their lending approaches or whether it be us in our acquisition of the property as an equity REIT, we're all looking fundamentally at the credit quality of that operator and their ability to survive through either the term of the loan or, in our case at NewLake, the term of the lease. And we make a lot of assumptions as underwriters with respect to market evolution and market dynamics. And we take a fairly conservative approach across, I would bet, all three platforms. I'm fairly familiar with what Dan and Peter do as well. And I think we all take that conservative approach to sizing a facility, whether it be a lending facility or whether it be a lease, like in the NewLake case, to fit the cash flow profile of either the tenant in our case or the borrower in their case. And so, bringing all of that to your question around what's the size of the box that we all necessarily have, and is it getting bigger or smaller? I think it's getting, on the one hand, it's getting bigger quarter after quarter as companies navigate through this difficult period, make the difficult decisions to be the ones that are going to last over the long term. And as we see competition diminish, I think margins will only firm. And you'll see the winners and the losers evolving. And we've started seeing it over the last 12 to 18 months. And so I think every quarter that a company is able to navigate these difficult waters, certainly for NewLake, it makes us have greater and greater confidence in their ability to be long-term winners.
Anthony, let me stay with you there. So in terms of, we talk about loan classes, right? Whether it's BDC, mortgage REIT, sale leaseback, given the context, right, without more sizable states going rec, demand for new capital may slow, right? Does this have any impact on any specific type of loan? So there's still good demand for all types, or are you in an advantage or disadvantage or neutral?
Well, listen, the way I look at the three of us on this call and, BDC that Peter had mentioned, these are capital sources for companies at different points in their evolution, also at different points in how they want to fund their capital stack. They're not always mutually exclusive. And get away from cannabis for a minute and look at the broader economy. You see companies tapping BDCs for capital. You see companies tapping banks for capital, tapping REITs for capital, and executing on sale leaseback in the general economy. And I think cannabis is really no different. And I like to think that there's a place within the cannabis sector for all of us to find the counterparty, again, in our case, the tenant, in their case, the borrower, that fits the profile of what they're looking for at that moment in time. I also like to say that the real estate that some of my colleagues will use as collateral today may end up finding its way into a sale leaseback as these companies evolve to more cash flow lending businesses in the future from more collateral heavy lending situations or needs in the near term. And so again, I think there's a place for all of us to play in the cap stack. And in some cases, we actually do play in the existing cap stack of the same company.
Thank you. Look, Peter, I want to go back to something that Dan said. I mean, this is just moving on in terms of questions. This idea of the debt capital imbalance, of course, equity has dried up. Debt capital, according to Dan, still very challenging. But we hear that there's more regional banks involved, and we hear that there's more private debt capital out there. But maybe that's wrong. And maybe you give us your view in that regard. And when you talk about that, let's talk about this narrative of this wall of debt that it's maturing in a year or two. How do you think about that? So there's two questions there. Thank you, Peter.
I have not seen significant new credit capital providers entering the space in recent months or recent years. There are a handful of regional and local banks that have incrementally become more comfortable with lending into the cannabis space. But I would say that their investment mandate and their purview of acceptable investments is relatively limited. And their motivation is equally, if not more, driven by the desire to attract deposits and is to find attractive risk-adjusted returns. And so it's a bit different angle driving their entry. And then lastly, if commercial banks are a relatively small proportion of the broader commercial lending market, and their share of the broader commercial lending market has been declining since the great financial crisis. And that explains the rise of private credit and firms like Dan's and Anthony's in mind that were much less prevalent prior to the great financial crisis. And so the idea that banking can solve debt capital needs for the cannabis industry just doesn't track with the broader economy and the role banking plays in the broader economy today from a debt capital standpoint.
Hey, Pablo, can I jump in on that for a moment, if I may? So, my view is that when the banks get involved in this sector, and as they get involved in this sector, the folks on this call are more likely to be able to garner those dollars because the banks will want to know that they've got a professional organization, professional asset management organization that is that first cut at analyzing credit risk within the portfolio. And I think you find that these regional banks may often prefer to have a diversified portfolio of risk by providing capital to Dan's platform, to Peter's platform. And in fact, Peter's BDC recently announced a raise that I think demonstrates this point. So I think the folks on this call are more likely to be able to get access to that type of capital. And maybe it comes into the industry, but probably through these platforms, a little bit more than directly into the operators themselves. And then also think about the expertise that these organizations have that are on your call here and our ability to understand credit versus a new commercial bank that is likely to be much more conservative in its underwriting approach, given the lack of knowledge they have about the sector, the companies, the individuals, and the regulatory landscape relative to what you'll find in Dan's shop or Peter's shop or here at NewLake.
Thank you. Dan, just on the same topic, but in terms of the narrative of a wall of debt maturing in the next year or two, is that a bigger source of risk for the industry and for you, or is that an opportunity? How do you think about that?
Yeah. Well, it's not really a narrative. You can go through the 10Ks. It's the reality, right? Like there's $2.6 billion of debt maturing with the publics in 2026. If you think about the capital cycle, a lot of that money was raised in late 21, 22. I was involved in that at my prior company. And as much as there is on the public side of things, you can probably double that up on the private side of things. So there's 2.6 with the publics. There's probably another 2.6 with the privates, which is a much longer tail. And so a lot of that debt was raised in late 21, 22, typically with a 4 to 5 year term. And so it's all coming due at the same time. Now, that's not to say that I don't think this gets done for the tier ones, especially. I think these deals are going to get done. The question is, what is the price, right? If you raised at 8-9% in 2021, you're as a large tier one public, you're potentially raising at 11-12% in 2025. And I think that's just the reality of one, the capital supply demand imbalance, two, the performance of these businesses relative to their projections, where they are today versus where they told these debt investors they were going to be back in 2021. And three, the move up in rates generally. And so I think tier ones, good companies, good credits, good cash flow, that continues to get done. But there's not an infinite supply of capital. And I think bad credits, bad operators, people who stub their toes, that potentially doesn't get done. And I think whether it's 2.6 or $5 billion, that's a lot of debt capital coming due at the same time. And so I think some of the larger credits in the space are going to suck a lot of the attention and oxygen out of the room, and open up opportunities for folks on this call, but also potentially lead to some treacherous waters for kind of the operators that are a step or two below the top operators and the top credits in the industry.
Right. Peter, do you want to add to that? I mean, comment on the same question?
Yeah, I'd say the only variable that's unknown, like we know that maturities exist and the quantum of those maturities. We don't know to what extent existing lenders in those capital structures will or will not be willing to roll into new facilities, participate in newly structured facilities. And that will determine whether that's the answer of, with these maturities, is capital leaving the market, entering the market, or staying the same.
Right. We want to talk about, loans that are being equitized in the market, but we want to keep that for later in the discussion. So maybe just staying on topic here, Anthony, what do you say to equity investors that mostly focus on sales and EBITDA of the PAVCos as opposed to maybe, balance sheet and cash flow metrics? What do you say to that? And then related to that, Anthony, although it's a separate question, pitch your stock, right? People are very focused on the plant-touching companies, and here are these lenders making very good yields and managing risk. If you can touch on both, Anthony.
Yeah. So I think for equity investors, I think you have to look at all of it, because for some of these companies, simply looking at their quick ratio, just looking at your current liabilities versus your current assets could create a screaming red flag that you may not want to be in that company anymore. But it requires you to go deeper, because maybe there's a current portion of tax liability, federal tax liability, that might be in there. And so the point I'm trying to get at, Pablo, is I don't think anybody could just look at sales, look at EBITDA in this sector and really have a sense for the quality of the company they're investing in, because the balance sheet in this industry is so critically important. Because as my colleagues were just talking about, with this wall of maturities and companies needing to induce, likely needing to induce some of the current borrowers to extend, because I don't see 2.6 billion, just using Dan's number, I don't see $2.6 billion of new cash coming into the market to be able to pay off the existing debt. Maybe there might be a little bit of cash coming in, but by and large, most of that debt will have to get extended. I don't see it also getting paid off, because most of the companies don't have free cash flow to be able to make meaningful pay downs. So if you're going to be extending, looking at that company's balance sheet is going to give you as an investor the sense for what leverage will they or won't they have in going into that negotiation, and thus what will that company need to do to induce the extension. And unfortunately for equity investors, that typically includes equity dilution. We saw that happen in 23 and 24 when some of those facilities were extended. And so that's where I think equity investors in cannabis have been surprised before, because they haven't focused on the balance sheet and they haven't thought about these maturities and the impact on them as equity investors through dilution. They've just thought about, how much should I value this company on sales or on EBITDA? And so I think that works in a regular way industry. I think in a capital constrained industry such as this, I think it requires a much more holistic review of the business.
All right, thank you.
So you want me to pitch the company? Listen, I wasn't thinking we're getting to pitches, but we'll pitch company. So for NewLake, what do we offer investors? We offer we're a yield, so we pay a dividend on a quarterly basis. And so some people look at our business and they say, my gosh, right now at these prices you're paying a 10% dividend yield. And typically in REIT land, if you have to pay such a high yield, it means one of two things: either number one, you have a crap portfolio, or number two, you have debt that's out of hand and you're going to have a debt issue. Well, we'll take those in reverse. For us, we only have $7 million outstanding of debt, or on over $430 million of assets. So barely levered. Some people even say we're unlevered. Now we have ample capacity of credit capacity to grow through our $90 million credit facility so we can continue to grow the business. But leverage is clearly not an issue for us today. And even if we use the full $90 million credit facility, we'd only be 1.7, 1.8 times EBITDA leverage. So still a very lightly levered REIT on relative terms. So let's then focus on the portfolio. And I think no portfolio in cannabis is immune to issues. I think we've all seen our share of issues, and our issues are public, and we talk about them quarterly. But when you look at the quality of our portfolio, I'll put it up against just about anybody's in terms of the quality of that portfolio and the tenant base that we have in it. And I point to our third quarter earnings call where we disclosed that we had an 83% AFFO payout ratio. AFFO for REIT is the measure of free cash flow. We paid out 83% of our free cash flow, that's after expenses, for a dividend. What that means on the flip side is we could see 17% of our revenue go away and we'd still be able to cover our dividend. And so in our view, it's not a credit quality issue either. So, when we look at NewLake, we think it's really a discount to the exchange that we're on because we're on OTC and we qualify in all respects to be on New York or NASDAQ, other than the fact that we focus on cannabis. So we think that discount is A, that sentiment that we talked about, and B, is that discount for being over on the OTC and not being on a New York or a NASDAQ with the liquidity profile that those give us.
Thank you. Look, I mean, for those listening, we typically leave this pitch your stock question towards the end, but I think in fairness to the speakers, I'm putting it here in the middle. So we'll resume the conversation. But Dan, I mean, pitch IFC Gamma to investors out there that are looking at the cannabis space.
Yeah, I'll just give a generic as opposed to a specific. We're a little close to Q4 reporting, and my GC's got a tranquilizer gun trained on me. But I just say look, when you can move up the capital stack and you can achieve or target to achieve equity-like returns, that back when I was on the buy side, that's something you do every single time. This is a volatile and emerging industry. You've seen the performance of the stocks that the publicly traded stocks that are represented by the people on this call relative to the performance of the underlying equities. This is a volatile, emerging industry that I think requires investors to enter with a margin of safety. If you're betting on federal legalization under this regime, which is comprised of a group of people that I think are not our friends in a significant way, I think you could potentially be waiting for a pretty long time. And this is a way to get a current yield at the top of the capital stack and earn an appropriate risk-adjusted return for investing in an exciting, growthy, emerging industry, but still a volatile industry that's capital intensive, with still a lot to be played out here.
Thank you, Peter. The same question for you, and if you want to, here differentiate between refi and lien.
Yeah, sure. There's piggybacking on a lot of Dan's thesis. It is investing in a volatile industry with a margin of safety, realizing attractive current yield in portfolios of senior secured debt, and importantly, I think realizing such returns and attractive returns to equity in each of our portfolios and companies in portfolios that have much lower back leverage than are comparables in the non-cannabis space. And so it's the ability to really generate similar equity returns and dividend yields in portfolios that carry much less back leverage than the broader market. I think is attractive differentiating point that exists for the companies on this call because of our focus in this industry that's underserved by broader capital markets. We operate two public vehicles, Chicago Atlantic Real Estate Financing, that's a publicly traded mortgage REIT, and Chicago Atlantic BDC, that's a publicly listed BDC, both traded on the NASDAQ. The mortgage REIT focuses on investments that include real estate collateral, and the BDC has more flexibility to invest in real estate backed collateral and cash flow based investments.
Oh, that's great. Thank you.
Pablo, I just jump in with one more comment for all the companies represented on this call. I think when you look at the yields that investors can get on these stocks relative to the non-cannabis peer set we'd all be compared to, I think what you'd find, whether it's the cash flow coverage in our leases, or whether it's some of the collateral coverage and coverages that my colleagues have within their loan portfolio, I think most investors that have been our stocks, if I were to go poll the top investors at NewLake that I talk to, plus my colleagues' top investors, they probably all say something similar, which is, I'm getting paid very well to wait for the cannabis catalysts that are on the horizon, and I'm happy clipping my pretty robust yield while I'm waiting for the catalysts, because while we may not go 10x the way an MSO would go if there were some positive catalysts for the industry, we certainly will benefit. And so people get paid that coupon while they're waiting to be able to get that bump once the catalyst that we all fundamentally believe in will occur.
That's great. Thank you. Look, just moving on to the discussion, but with short answers on this. Your view on the interest rate outlook, how is your book position in terms of fixed versus floating floors? Anthony, I'll start with you, but I'm sorry, Dan, I'll start with you, but just brief answers, please. I know it applies less to some.
Yeah. Interest rate outlook, you'll have to ask somebody much smarter than me. Our portfolio is either 90% fixed or at our floors. So we have only 10% exposure to floating, and those are on loans that have moved up significantly. We have repositioned our book, and so most of the new loans that we're doing, call it over the last 6-7 months, are either fixed or with very tight floors. So don't have much exposure there on the downside, and have decent exposure on the upside if rates were to move back up.
Got it. Peter, same question for you.
Very similar response. We tend to structure our loans at floating rates with a prime or SOFR floor based on the existing floor, which creates convexity to the lenders in case interest rates go up, and limited exposure to the lenders if interest rates go down.
Right. Look, we're going to move the discussion now to more company-specific questions. I'm going to start with the IIPR PharmaCann situation. I know, of course, we're being respectful to everybody, and we want to be very sensitive about what we say about other companies. But if I start with you, Anthony, any comments you want to make about that situation? I think your stock was impacted because of that situation, although it was resolved. Any comments you want to make, how it was resolved, and the impact fallout for NewLake, if any?
Yeah, I think we're happy to see that get resolved. It seems to have gotten to a place that works for everybody involved in that conversation. I'll leave it for my friends at IIP to make commentary, and my friends at PharmaCann. PharmaCann is a tenant in our portfolio. But I think what that situation really illustrated or highlighted for folks that maybe weren't clued into it is that for us, we're partners with our tenants. And this isn't a set it and forget it type of relationship. Understanding cash flow at the property level is critically important to sizing the right transaction for us at NewLake. And so we're always looking at EBITDA. We're always making assumptions on where cash flow can go in a particular state market, so we understand what type of a burden the rent could be in a world where pricing comes down significantly. And we understand these are 15 to 20-year leases, so we model that over the term. And so we try to structure deals up front in a way that we feel highly confident that over the life of that lease, that tenant's going to feel very, very comfortable paying the rent and generating free cash flows for themselves. But not everything goes the way as planned. As Mike Tyson famously said, you have a plan until you get punched in the face. But I think the dialogue that we saw play out in December and January illustrates the fact that there is this symbiotic relationship. You can't have one without the other. And so it's important to understand the industry. It's important to be a good partner to your tenant or to your borrower and work through the, because given this industry, you're not going to bat 1,000. Quite frankly, that's why we get the types of yields that we do, whether it's on borrowings or on sale leaseback facilities, because there is risk that you're taking in this. And so again, I just summarize it all by saying that these are relationships that need to be cultivated, that need to be managed, and need to be worked through when issues arise.
Thank you. Dan, same question for you. Any REIT for you as a mortgage REIT, if any?
I don't think there's much. It's just, look, it's a difficult industry to underwrite, and I think you have to be very specialized and very close to it, right? Because these markets change on a monthly, if not weekly basis. And you have to underwrite not just, the US cannabis market, but also the individual supply demand dynamics at the individual state level. And that applies both to supply demand in terms of, how much cultivation capacity is being built out, what is happening with the illicit market, what's happening with border states, and supply potentially leaking over one border to another or getting cross-border traffic, as well as the regulatory regime. Do you have a stable regulatory regime today? Do you expect that to exist tomorrow? What about 3, 4, 5 years into the future? In the case of folks on the sale leaseback side of things, 15 years into the future. And so I think you just got to be really close to the industry. It's very specialized. And I think, IIP and the rest of the players on this phone, do that, and they are. I think for anyone else looking to get into the industry, I think it's a bit more difficult when you're doing this part-time as opposed to living, breathing, and eating it every day.
Thank you. Peter, I'll move on to specific questions on Chicago Atlantic. Remind us, having the BDC in your toolkit now, how does that help the group overall, right? You have the refi, you have a lien, and I know you touched on it, but how does that help you, and how will you allocate future loans between the private side, between refi and lien? Let's start with that.
Fundamentally, the addition of lien gives Chicago Atlantic greater ability to deploy capital into the market, to provide more flexible and creative structures to our borrowers, and to speak for larger allocations in larger transactions when it makes sense. And ultimately, that ability to identify and source and build relationships and solve the benefits of our clients allows us to hopefully improve our ability to structure and win transactions with the highest risk-adjusted returns and the most attractive risk profile. For investors, the ability to deploy out of 3 vehicles allows us to build diversified portfolios in ways that's more difficult when allocating from a single portfolio with a singular risk mandate. As managers of 3 funds, we have an equal fiduciary duty to all capital sources. And so we allocate transactions to each of the funds to their ability to fund them. And each of the REIT and the BDC and our private funds have certain limitations that may or may not allow them to participate in all transactions that Chicago Atlantic originates.
Thank you. And Peter, one more for you on a different subject. If you can just at a high level briefly explain the Vireo Health transaction. It seemed to be a case of loans being equitized. I don't know what signal that sent to a market. How did that help Chicago Atlantic Group in general? Thank you.
Yeah, a really interesting transaction. We've been lenders to Vireo for more than 3 years now. And over a period of that time, we supported the company's growth and in the process developed a relatively large position related to convertible notes and warrants in the company that translated into a very large equity ownership in the publicly traded company. The transaction that Vireo structured and executed on in Q4 of 2024 and seeks to close in 2025 accomplishes a couple goals. One, it adds significant value to the platform by diversifying its footprint in some really attractive states with some of the strongest operators in the country. And two, it increases the market cap and the attractiveness of its equity significantly. The company raised more than $80 million of equity, new dollar equity concurrent with the transaction. And the company acquired each of these targets in all stock transactions. The result is a company that's really well positioned in some very attractive growing markets with some of the best operators in the country, and a company that is highly underlevered relative to its peers and poised for growth at a time in the market where very few are able to execute on attractive growth opportunities. So both it added value to our portfolio and the private funds that held Vireo equity positions. It reduces our ownership of Vireo significantly, so that now Chicago Atlantic owns a very, very small percentage of Vireo, whereas previously Chicago Atlantic owned a relatively large percentage of Vireo. And it creates a lot of fundamental value for the new company. And so in some ways, I see this transaction as both, it's a culmination of, I think, which the relationships that Chicago Atlantic has built over the last 6 years. It's a reset in terms of, and an example of how companies in a challenging equity valuation environment can still execute transactions and get deals done. And I think the company that's coming out of this is going to be a really exciting player in the market for the years to come.
That's great. Look, on the same subject, Dan, we've seen the case of Parallel. They have equitized, Sunstream, right? Sunstream JV, they equitize loans in Parallel. We're seeing this case. Is there any implication for other players in the industry? I understand everything I understand what Peter has explained here, but does this trend of loans being equitized deter borrowers out there, or there's so much need that it has no impact? How do you think about it, Dan?
Look, I can only speak for ourselves. We view things very black and white. Debt is debt, equity is equity. You play in one pool or the other. If you start to play in both, things can get messy. And so we are debt investors and focused on lending out money at appropriate risk-adjusted returns and partnering with our borrowers to allow them to have growth capital and grow their businesses and succeed with the ultimate objective of getting paid back. So that's going to be our focus. I think some of these other folks getting into the equity game and becoming operators, I think, I left the operations side of the business. I was at, Ascend Wellness for 5 years as part of the core team standing it up. And, the operating in this industry is very difficult, right? It's a federally illegal business. The cost of capital is high. Yesterday was always your best day because there's inevitably additional competition that's coming into these markets. And a lot of the other operators out there are no dummies, right? Like the Bens, the Kims, Abner, Charlie, all these folks are, battle hardened, battle tested operators who have learned through the school of hard knocks. So I remember, walking into the industry in 18, bright-eyed and bushy-tailed, thinking we were going to take over the world. And, here we are, 7 years later. It's a difficult category, a difficult industry. But I think there is certainly opportunity over a longer term horizon, and understand why some folks would take a different approach here. It's just not what we're going to do on our side.
No, thank you. Understood. I guess different strategies. But Peter, just one quick follow-up. I mean, one of the advantages of a BDC, the way I read I believe it's the 1940 Act, is that with a BDC, the company can work with management of those borrowers, right? And that's I don't know if that's a nuance that's important or not, but it seems to be an advantage for BDC. So at the end of the day, every lender can work with them, with their borrowers. How you explain that?
We work closely with our borrowers regardless.
Regardless,
and
right.
I suspect Dan and Anthony would say the same.
Okay, no, that's good. All right, thank you. And look, before we move on, Anthony, it's a bit of an academic question, but people ask the question about the total addressable market, right? Is a TAM for a sale-leaseback operator narrower and smaller than for a mortgage REIT or a BDC? How would you explain that? And I don't know if the question is well structured in the sense that we're talking about apples and oranges, but how would you answer that?
Yeah, I'd answer it with first, for those that aren't familiar with sale-leaseback, just a reminder about what this product is, and that this product is regular way when it comes to non-cannabis real estate. So if you were to look at a Walgreens or a Starbucks or a Home Depot or a FedEx, these are all organizations that have large real estate footprints. And what they recognize is that tying up their hard-fought capital or their hard-earned capital, it's not a good use to tie it up into a hard asset like real estate over the long term. And so they all utilize sale-leaseback as part of the complement to tools that they employ in their capital structure. And I think cannabis is going to be no different. There are a lot of companies today who say they don't want to enter into a sale-leaseback, but they believe that's more a function of the cost of capital of sale-leaseback relative to their alternatives. I don't think those executives are saying that they don't want that. What they want to do is tie up their capital in a hard asset like real estate. I think it really comes down to that cost of capital. So when I think about the addressable market, I think about the billions of dollars that sits on the balance sheet of public company MSOs, and then there's billions more on the private company side. I look at all of that real estate and I say to myself, over time, these companies won't want to be getting a single-digit return on investing in real estate for the long term. They'll have better uses for that capital, so they'll look to sale-leaseback for that non-dilutive use of capital. There's absolutely some overlap between what Dan and Peter do and what we do here at NewLake. But again, I go back to what I said a little while ago. It really depends on where the company is in their life cycle and what that management team or how that management team wants to approach their capital stack. So like Verano is probably the poster child for us to talk about in this regard. If you talk to them, they hate sale-leaseback. And the reason they hate it is they think the cost of capital for a sale-leaseback transaction is much more expensive than the debt. We'll see. We'll see. I've had those debates with organizations before in a world. And I never really answered your question earlier of where I think rates are going to go. I don't think rates are going down. I think we should be, and people can see how I've been tracking with this on Twitter. I've been saying that higher for longer. And I think that even though the Fed has started on this lowering rates, that really impacts the shorter end. And when you think about cost of capital for this industry, it's not priced off of the Fed funds rate. It's generally going to priced off of whether it's SOFR or a 5-year note or a 10-year treasury. And so the steepening of the yield curve that's occurred over the last 4 or 5 months is, I think, a trend that's going to continue. And that means I think the cost of capital for this industry is going to stay high for a longer period of time. And I think the risk-free rate stays high for a long period of time. So for people to say, or I should say, for people to expect the cost of capital in this industry will come down rapidly, what it's going to mean is that the risk premium for this industry is going to come down rapidly. I personally just don't see it. And so, I go back to your question. I know I've been long-winded here, Pablo, but my point is I think there's a sizable addressable market. It's just about how long does it take us to get there? And there will be some companies that are comfortable executing in the current time frame, and there are other companies, maybe a Verano, that may execute down the path, and that'll be future deals for us.
Okay, thank you. Look, I know we're running out of time, but we'll leave this last section, just to get your thoughts in terms of your views on what happens, what may happen on the federal reform front in 25 and 26. Dan, I'll start with you. I know anyway, your views on the subject.
Yeah. My view is kind of not much in 2025, maybe something on the rescheduling side of things in 2026. I think this appeal, we had to go through the DOJ, we had to go through the DEA hearing anyway, and so this appeal just kicks the can down the road and was a bit of an own goal that I don't think was necessarily driven by the industry itself, but some other participants within the industry. And so I think rescheduling is, probably, earliest in early 2026 event. And the administration has other priorities ahead of cannabis, at least in kind of the near term. But I could wake up tomorrow and be dead wrong on that. I think we build and position our business to not really take a view on that side of things. And I think anyone who has opined on these type of things on these type of calls previously has been dead wrong. And people should just stop. And the last thing I'd say is I think the industry working together, combining lobbying associations, is a good first step. Putting $50 million is a good first step. That's real money. But you're getting curb stomped as an industry by a guy with a, $3 million budget who's spent $140,000 a year on lobbyists a couple years ago. Like the first use of that $50 million should be taking $10 million to make Kevin said that go away, because we need to be coordinated and get the message out. And I think that at least over the last couple of years, we've been getting bested on that front. And so I think the new approach is good, but it's going to take time to yield results.
Thank you. Peter, the same question for you. Yeah, I don't have much to add. I think we spend our time focused on underwriting fundamentals of markets and companies, and less time thinking about what's the opportunity for upside driven by rescheduling, safe banking, simply because it's very difficult to predict. But I would see each of these as very positive catalysts for our companies, for our borrowers, and for the industry as a whole.
Thank you. Anthony, same question for you. I guess, without getting political, some people are here very excited about the idea of promises made, promises kept, but I want to hear your thoughts.
Yeah, I'm not going to be very different. Hope for the best, prepare for the worst. And I think like Dan and Peter both said, is we're all focusing on companies that don't need reform in order to be successful, right? That's the core of our business. So if reform happens, there's a net benefit to our business, but it's not necessary for success. Listen, I could sit here for 10 minutes and paint a very optimistic view on why something should happen in the next 6 to 9 months. Likewise, I could paint a very pessimistic view on why nothing will happen for 3 years. The reality is none of us know, right? We just don't freaking know. None of us have that expertise nor that crystal ball. And so our businesses just have to be ready for the status quo. And to the extent that there's a surprise to the upside, then we'll benefit from it. But none of us are really building our businesses based off of the expectation that reform occurs. And I'll close out my comment by repeating what I've said over and over again. I'll always take the over on timing Washington, D.C.
Thank you. Look, thank you very much to our participants. Thank you to everyone listening today. I mean, we'll take closing remarks. I'll start with you, Anthony. And as you know, you decide how you want to use this time, but remind us whether are you looking to lending to or in terms of sale leaseback, working with the hemp industry? Are you looking at overseas or are you very domestic focused? But again, on closing remarks. And thank you, Anthony, for joining us today.
Yeah, we're not actively looking to work with the hemp industry. I mean, quite frankly, when you think about why NewLake was started, it was to provide capital for that disconnect between state and federal law, where there was an absence of capital. And by and large, the hemp industry does have access, not regular way access, but they still, given federal legality, do have access to the sector. I also find that they tend to be they are less regulated, and they tend to have less of a compliance focus than what our current tenant base would be and what we like to see in a counterparty. As far as Europe, we've been paying attention to it. You know, you and I saw each other in Europe last summer. We've been looking at it. I don't know that there's anything actionable for us right now, but as we watch that market evolve, it's prudent for us to pay attention to what the needs are over there from a real estate capital perspective. You know, in terms of the long run, very much when we started this business back in late 18, early 19, the thesis was that cannabis reform would happen over time. It's just happening a lot longer and a lot slower than any of us want. But our thesis remains intact that if we could provide capital to this burgeoning cannabis industry, we could get about these above market yields, which are necessary given the level of risk. But if we could manage that well, we can have a quality portfolio with attractive yields that'll improve in value over time as cannabis is normalized. And quite indeed, we are on track for that. Again, not happening the way we want in terms of timing, but you had 2 presidential candidates on the trail talking about cannabis. You have cabinet secretaries talking about cannabis on national news. You have articles in mainstream media talking about cannabis, whether it's positive or negative. There's still a lot of talk about cannabis in the national limelight these days. And I think that's going to bode well. It's going to allow us to get more research, make more progress. So fundamentally, those reforms will happen. We'll just continue to pay our investors through the dividend until they occur.
Thank you, Anthony. Dan, closing remarks, and also if you can touch on the overseas and hemp opportunity, if there is anything.
Yeah, so I think on the hemp side of things, hemp beverages are here to stay. You know, if you go to markets where it's a little bit more open, where you have good distribution, it's, you know, 10 to 20% of sales on some of these liquor store shelves. So it's real. I think it's a good thing for the industry longer term because it's a familiar introduction or reintroduction to cannabis that could drive consumption of other form factors over time. So we view that industry as here to stay. It's something that we're lightly looking at, but it's difficult within the context of our public vehicle and the mortgage REIT structure. But something that we would like to address longer term. I think wider hemp, it's a bit more of the Wild West. I think you got to see what happens with the Farm Bill and whether or not any of those opportunities are actionable. But there seems to be a lot of creative destruction in the wider hemp format in terms of, you know, what's hot and what's not, and the rotation among the top 10 in brands across the country. Europe longer term, like this, you know, you already have a highly regulated industry in the US, you know, trying to maneuver in Europe, and have 2 layers of regulation, right? The regulation of the industry generally combined with the regulatory overlay of dealing with doing business in Europe just doesn't strike me as particularly fun or attractive for us right now. Doesn't mean that's not an opportunity longer term, but we see plenty of opportunities stateside and see that sticking to our knitting today. And then in closing, just, you know, wanted to thank you for having us today. I think it's great to have these conversations. Give the folks in the Twitter sphere a little bit of exposure to what's happening on the debt side of things. I think balance sheets and cash flow, as we talked about, is going to become increasingly important over the next 2 years. And we are ready, willing, and able to provide capital to fund the growth of the industry on the debt side of things. And are excited to work with our existing borrowers and new ones as they emerge.
That's great. Thank you, Dan. Peter, same closing remarks.
I think that the 2025 is going to be an opportunity for companies to focus on fundamentals, focus on organizations, and focus on thoughtful expansion, evolution of brands, and evolution of their relationship with the consumer. And I think lenders in the space, the FinCos focusing on the cannabis industry, are in an extremely strong position to support those businesses, to support those operations, and to create some really attractive risk-adjusted returns for investors in the process.
That's great. Thank you very much, Peter. Thanks again to our three panelists, and thanks everyone for joining. The call will be available in YouTube, in our YouTube channel, Spotify, Twitter, and other platforms. Everyone, have a good day. Thanks again.
Thanks, Pablo.
Thanks, Pablo.
Take care, Dan. Bye-bye, Peter.